All right, so today what we're going to talk about are the other parts of your group project. On Monday, we had talked through some of the valuation issues with Microsoft, and I said that today we wanted to go through both Macy's and Microsoft with the other parts of the analysis. So to help you with this, I got a question about what do you need to do for your group projects. So I put up an announcement on Canvas with a little bit more granularity on your group projects. So here are the requirements. So again, on Wednesday, December 4th, you're going to have to turn in a PowerPoint presentation. It's going to be a written document that all 6 teams will have to turn in on that day, whether you present that day or not. All right, the PowerPoint presentations are going to be 20 minutes per team, so 3 teams will then present on Wednesday, December 4th. The other 3 teams will present on Monday, December 9th. Okay, and we'll kind of decide on December 4th who presents. You should be ready to present on that day, and you must turn in your PowerPoint on that day. And for the teams that are presenting on the 9th, you can't change your PowerPoint. So that's why I want it to be handed in and printed, because there's an advantage to having the extra time to basically adapt, and I can't let you have an advantage of the extra 5 days. So everyone has to turn in their PowerPoint on that day, and that's the presentation you have to go with, whether you're doing that day or the following day. Okay? So the papers are going to be due on December 11th. Okay? So on Wednesday, December 11th, you'll turn in the papers. So that way you'll have time to take any feedback from the PowerPoint and adjust the paper. So essentially you're going to be presenting the information, the same information, 2 different ways. Okay? So everything that's in the paper is going to be graded just by what's in the paper. I'm going to ignore anything that you said in your PowerPoint. And obviously when I grade your PowerPoint, and I'm going to grade it right after you finish the PowerPoint, I'll give you a grade that day. I won't have read the paper. So they're going to be independent of each other. So you have to cover all the sections in the PowerPoint. You have to cover all the sections in the paper. The group project is worth 20 points. The PowerPoint is worth 8 of the 20 points. The paper is worth 12 of the 20 points. Okay? So again, you'll get a grade for 8 of the 20 points the day you present. The other 12 you'll get after you turn the paper in. You're going to have to do 4 sections in each one. They're explained in the last page of the syllabus, but here's some additional granularity about what you have to do in both. For the EIC section, when you do the E, in addition to talking about the impact of the economy, you have to turn in a 5-year Bloomberg beta screenshot. You have to turn in a current screenshot of the LEI and CEI from the conference board. Okay, so everyone will have that in your PowerPoint. Everyone will have that in your paper. In addition, for the 5 forces, you're going to have to put in a screenshot of the RV screen, which will have the ROIC and the WACC at the industry level with the industry weighted average. For the company, you're going to have to refer back to the RV screen when you talk about competitive advantage. And for the industry, you're also going to have to include the Excel table for the current and the future, along with your write-ups. Section 2, for the historical analysis, you're going to have to print out and put in an ROIC tree. So when you go through the ROIC tree in the PowerPoint, got to see the tree. And I'm going to have to see the tree in the paper referred to as well. Same thing with the CFI and the 5-year totals. For the multiple section, you're going to need to have 6 companies in your multiples. Your company plus 5 more. Now, realistically, you could have more than 6 peers, but for simplicity, I'm just saying do 6 peers. All right, so that way your analysis doesn't get too complex. If you want to make your lives more difficult, you can have more than 6 peers, but you can't have less than 6 peers. All right, you have to have at least 5 peers, 6 total companies. You have to have at least 5 other companies plus your own. Minimum of 6, right? And I wouldn't recommend trying to do more than 6. It'll make your lives more difficult. Then what you're going to have to do is put that data, either as a screenshot or an Excel export, into, again, the PowerPoint and into your presentation. Right? Next, the valuation section. You're going to have to do an as-is and a final valuation, but I'm only going to ask you to turn in to your paper the printout of your entire model for the final. You won't have to turn in the as-is, because I kind of know what the as-is stock price is, and you're going to have to focus on the assumptions. Why did I make the assumptions? Why did I change the assumptions? So you need to show me those. But for the final evaluation, I need to see your model, and that you're going to turn in the paper. You won't do it during the PowerPoint. You'll also have to do an ROIC chart. Right? And you'll have to turn in the ROIC chart in the PowerPoint and the paper because you're going to have to defend the ROIC chart as part of the presentation. So again, you're welcome to read the announcement. This goes through what's going to actually be required in more granularity, and we have now covered all 4 sections. So we spent a lot of time on the valuation, the as-is and the finals. Today, we're going to talk about sections 2 and 3, the historical analysis and the multiples. And we're going to give examples for each. Yeah.
The ROIC chart, that's the Excel evaluation?
The ROIC chart, as opposed to the tree, I'll go back to the Macy's model here. The ROIC Drivers tab is the tree. The ROIC chart is the graph of the historical and future ROIC. Because this graph of the prospective ROIC is one of our reality checks on whether or not we have a reasonable valuation. Because you're going to have to defend this chart. So at the end of your valuation section, you're going to say, we think the company's trading at X. We believe the company is worth Y. Buy, sell, hold. Part of our analysis is whatever. And here is the graph of the ROIC, which supports our final valuation. This is why we think that this is a reasonable graph. Okay, so that's what you're going to do with the ROIC chart in the project. Other questions about your group project, group assignment? By the way, you're also going to do a peer evaluation on your group projects. So what that means is that by default, everybody gets the same grade. However, if one or more of your team members is not working at the same level as the other team members, then you will have an opportunity to submit a peer review to basically say they worked 50% on what they were expected to work on the project, and therefore they should get 50% of the group grade. So what's going to happen is if one person on your team gives you a negative peer evaluation, it won't affect your grade. But if more than 2 people on your team give you a negative peer evaluation, I will reduce your group grade. So I'm mentioning this in advance so that you know that you shouldn't really have this as an issue. Right? So again, I don't want it to be sort of ticky-tack where somebody worked 98% versus 100%. Like, that's not the point of the peer evaluations. I think we want to be reasonable that this is a group project. But at the same time, if you're not showing up for your group meetings, if you're not writing any of the presentation, if you're not helping your group in any way, you're not just going to get a group grade. It's a group project. You should all be contributing to the group project. So please work it out with your teams. If you think you're going to have any trouble with that, talk to your team members. If I need to intervene, talk to me, particularly before the project is due. All right, the worst time to talk to me is the day after you do the presentations, when your team members have said you didn't really do anything, and then it's too late. Right? So hopefully that won't affect anybody, but nonetheless, that's going to be the other thing that will impact your group project grade. Okay? All right, so as I said, today what we want to focus on are sections 2 and 3, and at this point in the semester, we've pretty much covered everything that is necessary to work on the group projects. And then the other thing I'll mention is that tonight, I will post a extra credit assignment. Right? It'll be worth 3 points. It'll be another company that we haven't talked about this semester. You will have to go to the Bloomberg lab. You'll have to pull out all the data. You'll have to write up an ROIC tree analysis. You'll have to write up a CFI analysis, and you'll have to write up a multiple analysis individually. Right? Each section's worth 1 point. It's extra credit. It's just practice for your group project. Right? And practice, again, getting more data out of Bloomberg to help you do that. So that's going to be due on Monday. Right? So again, optional, extra credit. You don't have to do that. But this is the only extra credit that I'm going to offer between now and the final exam. So if you're looking for extra credit, this is your opportunity to do the extra credit. It's 3 points. Okay? Questions? Yes?
Is it 3 points towards homework grades?
It's just you have 100 total points for the semester, and you have 103 points to make 100. So whether or not if you're perfect now, then you could be less perfect later. All right, if you did not do well on a previous assignment, then you could use this to essentially make up for lost points on a previous assignment. So it's not going to be geared towards any one assignment. It's just, as I said, you have 100 total points to calculate your grade this semester. This is 3 extra points, but I'm not going to do it out of 103. I'll still do it out of 100. Other questions? Good question. All right. So, as I said, I want to talk about, first we'll talk about the ROIC tree. And that is what's called the ROIC drivers. Now, when we go through the ROIC drivers, and this is for Macy's, okay, so I'm going to go back and use the Macy's model under the ROIC drivers chart. So there are three things that we said that impact end of year or EOI ROIC for a company, right? They're the tax rate, the operating margin, and the invested capital divided by sales. So in this case, what we want to do is we want to talk about the change in the 5-year ROIC from 2009 to 2013, and this is the percentage change over the 5-year period of time. But because you're going to have 20 minutes in your PowerPoint and you're going to write a long paper, then you'll have the opportunity to talk about the intervening years as well, some of the highlights. But in this case, Macy's went from 8.5% to 12.5% ROIC over that 5-year period of time. It's also important that you specifically reference numbers when you're doing your write-ups, when you're doing your presentations. It helps the person that's following the analysis really see what you're referring to. And meta, it actually helps with your credibility. All right, subtle, but if you talk about the numbers, it makes you sound more credible than if you just talk in generalities. Because if you talk in generalities, people think that you don't understand the numbers. So again, it's subtle, but you need to have practice doing that. That's part of what you're going to have to do here. Second, why did the ROIC go up by 45.9%? Well, first driver is cash tax rate. At Macy's, their tax rate went from 2.7% to 36.5%. Now, obviously 2.7% looks like an outlier, 2009, right? But that's the point. Their tax rate went up dramatically, which would have hurt their ROIC, which suggests that their real improvement in performance in ROIC was based on their operating performance pre-tax. It wasn't because of the tax rate. In fact, their tax rate went more unfavorable to the impact on the ROIC, right? And we can also realize that 2009 was an outlier. So remember, the other part of doing this analysis is ordering. There's a reason why I'm having you do the 5-year historical before you do the valuations, because this is going to help us when we eventually do the valuation, right? Because in this case, I'll know that even when I think about the tax rate, that I already have an outlier here, and I'm going to need to adjust that when I think about the future tax rate for the company, right? But I'll go back to this analysis. So pre-tax ROIC went from 8.8% to almost 20%, right? And 123% increase in pre-tax ROIC, and it was a pretty good progression each year for the last 5 years. Now, drivers 2 and 3 of pre-tax ROIC are operating margin and invested capital divided by sales. So, if we look at the operating margins for Macy's, their operating margins went from 5.6% to almost 10%, to 9.6%. So, a lot of the important impacts on the improvement in ROIC were due to the improvement in the operating margin. Operating margin went up almost 71%, right? Versus the productivity. Productivity, in 2009, to generate $1 of revenue, they spent 64 cents. In 2013, they spent 49 cents, a 23.5% drop in their productivity. So in the case of Macy's, they actually benefited by both improved margins and improved productivity. They're spending less capital to generate the same amount of sales, and they're getting better margin. Okay? Now, second level of analysis. What caused the change in operating margin? What caused the change in invested capital to sales? The income statement is the first one. Gross margin, also known as gross profit, minus the selling general administration, the operating expenses, equals selling general administrative, minus depreciation and amortization, equal operating margin. This minus this minus this equals that. Okay? So, why did the operating margin go up? First, gross margin. Gross margin is essentially the markup on the merchandise. It's the difference between the price and the cost of goods sold. Well, it went from 44.8 to 44.1. Their gross margin actually went down, which suggests they're not getting better markup on their merchandise. They're getting worse markup on their merchandise, which means their operating margin shouldn't have improved because of that. Not selling their clothes at a higher price, right? So It's SG&A. SG&A went from 34.1 to 30.6. They had a 10% decline in their SG&A. So basically the way that Macy's did better is they cut their spending on operating expenses far more than the reduction of their margins on their merchandise went down. Okay, so it's really an optimization story for their business. Depreciation and amortization as a percentage of sales went from 5.1 cents to 3.8. It also suggested they're getting better facility utilization. Because you have to remember, depreciation is a fixed cost, right? And volume, the revenue, changes. So this suggests that Macy's probably grew, and therefore they're getting better utilization out of their stores, right? Now, I'm going to see the same thing when I look through the balance sheet ratios, because that's going to show up in the PP&E to sales. But we can kind of infer this, and we can go check this on the income statement. Historically, over this 5-year period, Macy's revenue went from $24.9 billion in 2009 to almost $27.7 billion in 2013. So their revenue did increase. In fact, we can see this. Operating expenses went from $8.48 billion to $8.482 billion. They basically went pretty much flat. So they grew without spending any more money. That was really the improvement in the financial performance, and probably the improvement in the stores themselves. In fact, we could have seen that in the balance sheet. On the balance sheet, if I looked at net fixed assets, which is PP&E, where was it? $10.4 billion. By 2013, $8.2 billion. So basically, they're not investing a lot in their stores. They're probably getting better store productivity. Therefore, that depreciation is being spread out over more revenue. And that's also helping their operating margins, right? Which infers why on, let's go back to the ROIC drivers, why on the balance sheet are they getting more productive? Well, 3 things that drive balance sheet productivity. Operating working capital divided by sales plus PP&E divided by sales plus intangibles divided by sales equals invested capital divided by sales. These are kind of the 3 buckets of invested capital. Add them up, you get the IC over sales. In this case, operating working capital as a percentage of sales went from 7.1 to 5.9, a 16.6% drop in working capital. That improved the performance of their business. PP&E as sales dropped by 29%. It went from 41.9 to 29.6. Again, same idea. Revenue went up, PP&E went down. They're getting more productivity out of their store assets. Intangible to sales, 15 cents to 13.5 cents. Intangibles are purchased. This is purchased intangibles. This is goodwill. So in this case, remember that's fixed cost as well. So this gives us a sense of the productivity of what they've acquired through acquisitions. And it suggests they're getting more productivity. They're getting more sales relative to the purchase price. Okay? So they're getting productivity across the board in their balance sheet, which is leading to a better productivity, which is helping their ROIC. Right? So if I can really think about it, what were the primary reasons that their end-of-year ROIC went up so much by 46% over a 5-year period of time? It was primarily the reduction of SG&A, the overhead expense, of 10% during those 5 years, and the improvement of facility utilization, which was the biggest number and probably had the biggest impact of a 29.4% improvement in productivity of their PP&E. Those were the 2 biggest drivers that led to the increase in pre-tax ROIC, which influenced their after-tax ROIC over time. So again, I've already started to shape my story, and I've already started to think about what it's going to impact on the analysis that I'm going to eventually do on my valuation. All right, so what we want to do next is we want to look at Microsoft. So for those of you that may not have the Microsoft file handy, I did post to Canvas under the Files section for both Macy's and Microsoft. Like there's the as is for Microsoft that we did on Monday, and there is a file for Macy's which has the historical data. So if you're trying to follow along, the data's there if you don't have your files handy. Right? So let's go back and let's talk about Microsoft. Same analysis. So I'm going to go back to the ROIC drivers, and I want to walk through that tree. Now, for Microsoft, their end-of-year ROIC is ridiculously high. And this is just the nature of technology firms. The technology firms generally don't have a lot of physical assets. They're people businesses, they're service businesses. So they tend to have much higher returns on invested capital. So really, when we value them, it's going to be much more about the cash flows. But nonetheless, it's also going to be more about their income statements, right? Because they typically don't spend a lot on their balance sheet. It's mostly investments in their income statement that are going to, their operating expenses, etc., the people expenses, that they have to cover those costs when they generate revenue to generate cash flow. So for Microsoft, they're going to be more sensitive to the operating margin. But nonetheless, we can at least get a sense of the tree because the tree applies to anybody. So for Microsoft, their end-of-year ROIC went from 109%, 108.6 to 133. 22.7% increase in end-of-year ROIC over the last 5 years. Some of that was influenced by their tax rate. So in 2009, they were paying 26.5% in taxes. By 2013, that fell to 19.2%. That was a 27.6% drop in the taxes they paid, which boosted their after-tax ROIC. Right? So where at Macy's, the tax rate actually hurt them, at Microsoft, it actually inflated the impact of their after-tax ROIC. So a good chunk of that improvement was based on better taxes. But they did have an improvement in pre-tax operations. Their pre-tax ROIC went from almost 148% to 165%. Again, two drivers: margin, productivity. First, operating margin. Operating margin went from 35.4% to 34.4%. They actually saw their operating margins decline by 3%. So at Microsoft, the pre-tax ROIC was in the productivity. It was invested capital over sales. Went from 24 to 21. Right? So the story of Microsoft is actually a story of declining and deteriorating margins offset by a little bit of an optimization on productivity and a little bit better tax rate. So it's a different story than Macy's. Macy's was absolutely getting better margins during this period of time. Microsoft was getting worsening margins during this period of time. So let's drill a little deeper. Gross margin in Microsoft went from 83.6 to 78. This suggested a loss of pricing power because their gross margin fell by almost 6%. Right? So that's the difference in the price and the cost. Now, gross margins are pretty high for software companies because the actual cost of producing software that you're distributing is relatively low if you take out all the R&D, which is the SG&As. But if you look at their SG&As went down, sales, general, administrative expense from 43.8 to 39.6. They went down faster. And depreciation went from 4.4 to 4.8. Didn't change all that much, but that would have actually hurt their operating margin slightly. So Microsoft is all about reduction in SG&A expenses. They spent less to offset slightly declining margins and maintain and improve at least their margins, or at least try and maintain similar margins. Yeah.
But this is where you're saying the R&D expenses go into?
Typically in SG&A.
So for a software company that relies on the fact that they can stay on the cutting edge, doesn't this sort of display Microsoft's deterioration? The fact that they're not...
You're leading to the point I was going to make. So because we didn't do this analysis on Monday for Microsoft, right? When we were doing the as-is valuation, I said, well, just very flippantly, how do we get to the as-is? Microsoft's not going to grow. Similar margins, but not grow. But by doing this historical 5-year analysis, we see that was kind of flawed because Microsoft has actually been experiencing a deterioration of margin. And they probably will continue to experience the deterioration of margin. And the way that they're kind of covering up this deterioration of margin is they're slashing expenditures. And they're cutting expenditures. So fast forward, that's one of the biggest challenges I think that Steve Ballmer faces running Microsoft. Is what Steve Ballmer has been doing is he's been optimizing Microsoft. He's been optimizing their margins by slashing expenditures. And he's been doing this while we're in one of the greatest wealth creation booms in the history of the world in technology, where technology firms are all about spending money to go after this growth, and Microsoft is actually spending less money to protect their margins. And I'm just saying there's cognitive dissonance here, because yes, they're getting absurd margins, and yes, they're making a lot of money, but you're right, they're not spending in the areas that are helping them get the growth. They're actually trying to spend less. And maybe they're thinking, hey, we're not spending efficiently, but nonetheless, you are starting to see some deterioration of margin. Okay. Now, productivity. They did improve their productivity. Why? Well, their operating working capital went from negative 10.3 cents to negative 10.8. So again, they don't have a lot of inventory. They're a software company. It's all receivables primarily. But nonetheless, they did improve their productivity. Their PP&E to sales went up. Sorry, stayed about the same, 12.9 to 12.8, actually went down. Productivity went up by about 0.5%. And intangible to sales went from 21.4 to 18.8. So really, the improvement in productivity came primarily in intangibles, which one are non-cash items, and it's on previous acquisitions. It's not from the actual investments in the facilities themselves. Yeah.
Where's the value of patents going to go?
Again, if you build the patent yourself, it doesn't show up on your balance sheet. It's only if you purchase somebody else's patent can you put it on your balance sheet. So the way that's, again, a challenge with accounting, because accounting doesn't know how to value intangible assets, so they don't. Only if you purchase them at an arm's length do the value of the intangible assets show up. So these are purchased intangibles. These are not the actual built intangibles.
But this is still showing that same trend of where the successful software firms, namely Google, Amazon, are spending a lot
and
on
even Apple
servers,
yeah.
And that's going to be your PP&E. They're spending money to eventually get that money, and intangibles. They're buying all these small companies. Google just bought Waze.
That's right.
And they're buying these things, and Microsoft is showing again, we're not going to invest in our future. We're going to try to claw whatever we can for this moment.
That's right. And I'm saying you're starting to see that story, and I know it's colored by what happened today, or at least in recent times, but nonetheless, you can start to see the seeds of the trends of what's happening. So, as I said, when we do our as-is and final valuation, this will help shape our assumptions on a go-forward basis. So, as I said, if we go back to Monday, when I said, hey, flat margins going forward, declining sales, it's probably not realistic. Microsoft is probably experiencing continued deterioration of margins, and they're not investing in the things today at the same rate as their peers to maintain those margins, which probably prompts some worry by people. And again, my guess is this is highlighting the challenges of Ballmer, because Ballmer was all about optimizing the profit margin. He wasn't about building the future. And you kind of see that in the numbers, because as their margins were struggling, what did he do? He cut their costs further. He knows how to do that. Okay. Now, CFI. And by the way, there's a third level of analysis, which I'm kind of skipping over. So consider this optional, which is some of the components of working capital are inventory, DSO, and payables. Right? So in this case, their inventory did go up, but it's a relatively trivial amount. The DSO went up, and their payables went down. So, as I said, this is one of the challenges, which is they have some other assets which are causing them to be more productive, which are not in the big three. So you can still look at these as a general guide to what's happening in working capital, but it doesn't exactly explain what's happening for Microsoft. And again, I'm considering this optional in your papers and projects, but the data's here.
But we're talking about, from an investor's perspective, where payable days are going down. So that's saying that they have less time to pay their debts back. And that means that they're losing the trust of lenders. Isn't that sort of also a bad sign?
Or, that's what I say, it gets a little bit either or. Or what they're doing is they're recognizing that smaller vendors need the cash. And by paying them a little bit faster, that they actually could be using that to their advantage. Because you can't squeeze your supply chain when your supply chain is short of cash. So in this case, they actually might be trying to help their supply chain to get better leverage, possibly even more sales. All right, so back to CFI. Analysis number 2 is CFI. You have to hide years 2014 through 2024. Don't delete, because if you delete them, you'll wipe out the model. So just hide. So that way the totals are then shown here on the screen. So as part of your historical analysis, you also have to do a 5-year cash flow. Now remember, everything that I just did in your PowerPoint presentation, You have 5 minutes to do the CFI and the ROIC chart, so you really have about 2.5 minutes. You're going to have to be efficient when you talk through this. Right? I'm going through a little bit more detail. And I'm giving you more detail by going outside of the statement, but nonetheless, you got another 2.5 minutes or so to do this statement as well, assuming 5 minutes for each section of a 20-minute PowerPoint presentation. And again, you got about 3 pages. The paper should be about 12 pages long for analysis, about 3 pages or so per section is what's typically been done. So you got about 3 pages to write this up. Okay. Now, let's talk about the second historical analysis, the cash flow available to investors, CFI. You must talk about 4 sections: the operating, the non-operating, the debt, the equity. You have to talk about the historical 5 years and any particular big items during the 5 years, and you have to be specific on numbers. Okay, so make sure you refer to actual numbers in your analysis. So, Microsoft, last 5 years, gross cash flow, $113.4 billion of gross cash flow, profit from the income statement, cash profit. Pretty much steadily increasing for the 5 years, with one exception of 2011, but the general trend has been an increase each year in the gross cash flow. Gross investment has actually declined from spending almost $7 billion to about $5 billion, about a 17% reinvestment rate, 83% theoretical payout rate, just from their operations before acquisitions. So again, back to Microsoft. You know, we're in a giant tech boom right now, and they're not really investing in the tech boom. They're taking a lot of their cash, and they're making it available for payout. Okay? So they're protecting their ROIC. They're not investing in the future. So a good example of this, just as an aside, is that I also teach a part-time MBA class. And on Monday night, one of the students in the part-time MBA class said that he just was invited to go to Nebraska, where Berkshire Hathaway was running a session for college students, and Warren Buffett spent 2 hours with them in a Q&A session. And there were 140 college students from, I think, 7 universities or something like that in the auditorium. That was great. 20 students went from Maryland. He was one of the 20 that went. He took copious notes. And he was like, gee, everything we're talking about in class, like Warren Buffett is giving similar examples from. So he's all excited about that. But as a matter of fact, one of the examples he said that they used in the Q&A session is Warren Buffett talked about the moats. And he said, I've been talking about moats for over 30 years. It's interesting that they've just been popularized in the last couple of years, but moats are really important. And he said his example of moats is that when he invests in a company, he says that the companies like the Castle, you need the moat to figure out if they have competitive advantage and they have a defensible market position. And then you need to have a moat. And then he said, what I also want when I invest in a company is I need a knight in the castle whose job is to go get more land around the castle to grow the business. So I need a smart, aggressive knight, and I need a big moat. That's what he looks for when he invests in companies. There's little kind of simple ways of explaining investment. But the problem is, if you think about that analogy with Steve Ballmer and Microsoft, the problem with Steve Ballmer is the knight is protecting the moat. The knight is not trying to aggressively expand the land around the castle, right? Because that's what he's doing here. He's taking the cash and he's paying out to the investors. He's not really trying to aggressively expand Microsoft's position into the different marketplaces because he's optimizing the financial position of Microsoft. He's optimizing the financial payouts. And as their business is getting tougher, he's actually taking his foot off the gas to maintain the margins. He's not spending to get into new markets. And that's what you can clearly see as a trend that's been happening over the last 5 years. Now, if you look at the free cash flow, they did spend a little bit on goodwill. But remember, not too much in acquisitions. And free cash flow was about $92 billion. So for non-operating cash flows, what did they do? Well, $53 billion of the $91 billion just went into their checking account. They increased their cash every year for the last 5 years. They've kind of been hoarding cash. Now, part of this also has to do with U.S. tax laws. Most technology firms, Microsoft included, are earning a lot of cash outside the U.S. And under our current tax laws, if you bring the cash that you earn outside the U.S. back to the U.S., you take a 35% hit. If you leave it outside the U.S., you don't pay any taxes. So the taxes aren't paid until you actually repatriate the cash. So that's what's been happening is Microsoft, Google, Apple, leaving their cash outside the U.S. so they don't have to pay that tax hit. And right now they're just leaving it in cash. And what they're hoping is that one day the U.S. government which looks at all this cash that could be brought to the U.S., is going to be brought through a tax break. They're hoping that there will be a tax holiday because there's been tax holidays in the past. And they're assuming that it will happen again to repatriate all this cash. It's kind of like a game of chicken the tech companies are playing with the U.S. government, but eventually the government's going to want that cash back. Or what they're going to start doing is, I got all this cash outside the U.S., I'm going to start investing it outside the U.S. So you know what? My next R&D center is going into China. It's not going into Silicon Valley. And that's where they're also hoping that the U.S. government will get smart and let them bring the cash back. But again, that's a lobbying effort. But nonetheless, Microsoft has been hoarding a lot of cash. Now, that still gives them $38 billion that they've paid out over the last 5 years. But interestingly, they've increased their debt almost $16 billion. Now, for Microsoft, part of the reason they're increasing their debt is because they're borrowing against the cash that's overseas that they don't want to pay the taxes on. So they're borrowing it cheaply, and they have a pristine AAA credit rating that allows them to do that. And then what they're doing is they're using that plus the excess cash that they're not putting in the bank to basically pay dividends, $28 billion worth of dividends, and $42.5 billion worth of share repurchase. Okay? But they are leveraging their balance sheet, taking advantage of the tax shield, and taking advantage of the fact that they can borrow against cash outside the U.S. pretty cheaply, and pretty much use that to help them buy back some additional shares of stock, return cash to shareholders. Right? Because it is confusing to a lot of people. Why are you returning all this cash yet hoarding all this cash and borrowing money to do so if you have cash? And part of it has to do with tax policy. Again, not something you have to be describing in your analysis for your group project, but just additional kind of color commentary what's been happening to Microsoft. But as I said, we cover all 4 sections. We talk about some of the general trends throughout the years, and we refer to specific numbers. Questions about that? By the way, in a previous class, I'd actually let the teams kind of go through this themselves because I'm recording this on video and I don't have time. So I'm not pausing to let you guys go through this. So it'll be on video as an example. Just letting you know. All right. Let's talk about Macy's. What's the story of Macy's CFI? Well, over the same 5-year period, $12.5 billion worth of gross cash flow, $3 billion worth of gross investment. Again, Macy's pretty much beginning in 2010 increased their gross cash flow each year for the last 4 years and generated $9.4 billion of free cash flow before acquisitions. They did some kind of write down in 2009 or selling off of assets of about $5.4 billion. That gave them about $14.8 billion of after-tax free cash flow. Now, what's interesting is that for Macy's, they also spent almost the same amount, a little bit more, $5.56 billion, $5.6 billion in non-operating loss associated with the gain in the drop in goodwill. So what this suggests is this was just a write-off. And the cash impacts are essentially going to get washed out because if you take out the cash impacts, they only had $534 million of CFI after the other non-operating investments in 2009. After the free cash flow of about $1.7 billion. So it really makes sense that this was probably more of a write-down. But in any event, if I go back to this, they had about $7.6 billion of CFI to pay out after non-operating investments. What did they do? $1.8 billion went to pay off interest, about $2.8 billion to pay off debt, mostly in 2009, 2010. They paid out $860 million of dividends, steadily increasing since 2010. After the drop between 2009 and 2010 in the recession. And they bought back $1.9 billion worth of shares, mostly in the past 2 years, mostly as their free cash flow has been consistently high the last couple of years as they've basically taken the cash and they have redeployed it. The biggest difference between Microsoft and Macy's, though, is Macy's isn't looking at the giant increase in the mobile market as an opportunity. They don't have that in retail. So they're looking at a mature retail business with not a lot of growth opportunities. So for them, it makes sense to optimize. And you can see that they are optimizing by paying out a lot of cash. All right, that's CFI. That's the ROIC tree. Questions about either? All right, next. you're going to have to do a multiples analysis. As part of your multiples, you're going to have at least 6 companies in your multiple analysis. So that means your company plus at least 5 peers. Now, you can have more than 5 peers if you want. It'll just make your lives more complicated, so I don't recommend having more than 5 peers. But you have to have at least 5 peers plus your own. Minimum of 6. So I recommend 6. All right, in this case, I picked 5 other publicly traded department stores. Now, ideally, I probably wouldn't have wanted to use JCPenney's and Sears, only because they got a bunch of NAs. NAs mean not available. And the problem is both companies are losing money, so they don't really have enterprise value to profit ratios because they don't have any profit. They don't have a price to earnings ratio because they don't have any earnings. So I'd probably want to pick different peers, but nonetheless, I just picked those 6 just for convenience. Right? So I then select stats, make sure I do the market cap weighted average, and then I want to talk through the multiples. Generally, what I'm going to want to do, yes?
No,
Oh.
just stretch.
I'm sorry?
Just
Stretching? Okay. Generally, what I'm going to want to do is I'm going to want to talk about my company against the average and a few other peers, helping me understand what's happening with my expected, remember, multiples are growth in ROIC, or growth in spread. So what's happening with the growth in ROIC primarily, and why are different companies trading at different prices? Why is my company trading higher than the market average at a premium, lower than the market average, what's called a discount? Well, in this case, Macy's, let's look at its multiples. First, EV to sales. One of the things that the book talked about with enterprise value to sales is the enterprise value to sales ratios help us understand how much we're willing to pay for the sales of a company. Well, if I have a higher EV to sales, it generally means that my sales are worth more, which means I probably make higher profit margins. So EV to sales are going to be influenced by higher profit margins or lower profit margins. In this case, Macy's, relative to the average of these peers, appears to have slightly higher profit margins. People are willing to pay more for their sales. Interestingly, though, people are not willing to pay as much for their profits themselves. EV to EBITDA is lower than the industry average. EV to EBIT is lower than the industry average, and the PE is lower than the industry average. So I pay more for my sales, implied margins on my income statement, but I pay less for the actual profits off the income statement. Why are the profits worth less? I'm either not growing those profits at the same rate, or I'm getting worse return on investment. I'm spending more to get those profits, reinvesting more of my free cash flow. Well, in Macy's case, the market is expecting them to get faster growth over the next 5 years, which infers that Macy's probably has the challenge of lower ROIC. And in this case, we talked about PEG ratios being one of the proxies for ROIC. Macy's has a lower PEG. I'm not willing to pay as much for the earnings growth at Macy's as I am the other peers, probably because they're not worth as much. Price to book is about the same, but given the lower PEG, the lower profit multiples, and the higher growth rate, I can infer that Macy's is probably earning less of an ROIC. Now, if I looked at another company like Calls is not growing nearly as fast as the market or Macy's. But interestingly, Calls probably has slightly lower margins than Macy's. I'm not paying as much for their sales. About the same as the market this year, a little bit better than next year. But for Calls, their enterprise value to EBITDA is lower, their enterprise value to EBIT is lower, and their PEs are lower with lower growth, yet their PEG is slightly above the market weighted average. Now again, price to book lower, but here's what I would infer. Probably similar or lower ROICs to the other companies. The difference is lower growth, slightly lower or same ROIC, lower multiples. Now, at the other end of the scale, I have Nordstrom's. Nordstrom is probably the class of the industry. Highest EV to sales, high multiples of earnings across the board, and the highest growth rate, the highest PEG, and the highest price to book. So Nordstrom probably has both a combination of high ROIC and high growth. And if you remember, when we valued Nordstrom's, the market was expecting them to have revenue growth somewhere around 8%, right? So again, profit growth around 12%. Nordstrom's is growing pretty fast. They're expected to grow reasonably fast, much faster than the retail market in general. And Nordstrom has really good returns because of their high margins, which you can also see in their enterprise value to sales. So great growth, great return, highest multiples. Now, not double the rest of the industry, but nonetheless higher. In fact, this also gives us a sense of the trading range of the industry. What is somebody willing to pay for EBIT? What is somebody willing to pay for EBITDA? What is somebody willing to pay for sales? And generally, there's a wider range of what people are willing to pay for sales. For the poor performers, JCPenney and Sears, who are losing money, their sales aren't very valuable at all. For the companies doing well, Nordstrom sales are extremely valuable. $1 of sales is worth $1.05 at Nordstrom's. $1 of sales is only worth 28 cents at Sears. Okay, so when Nordstrom grows, they're growing and creating value with the growth. The more Sears grows, they're not really adding a lot of value. Dollar of growth only adds 28 cents of value, right? So if you really think about it, why? One, they're profitable, but two, they're getting good rates of return on their growth because they're getting higher multiples. So again, that's how this will play out. But what this also does, and this is really another type of analysis you're going to have to do, and we're going to cover this in the next class on Monday to let you know, which is when we do our valuations as a sanity check, these are the actual prices that people are paying for companies in the market today. Well, when we do our valuations in our model, we are inferring a multiple. So for example, at Macy's, we are predicting an enterprise value for Macy's. At Macy's, we are predicting a forward EBITDA for Macy's, a forward EBIT for Macy's, a forward revenue for Macy's, a forward earnings for Macy's, net income, which means enterprise value to EBITDA is actually already in our model. Okay? Enterprise value to sales is in our model. So when we do our final valuation, one of the things we're going to talk about, this will be the last kind of nuance of the valuation we'll do in the next class, is we want to not just look at our final stock price and what that ROIC chart infers. We want to look at the final stock price and what the multiples infer. We're going to call these implied multiples. And we're going to compare these multiples against what we see in the real world. So that if we see multiples in the real world that don't make sense, then what we're going to do is we're going to adjust our valuations accordingly. Okay, so basically if I come up with a valuation for Macy's and I say their final stock price gives them an EV to EBITDA of 10, well, nobody out there is even close to 10. So that's probably an unrealistic valuation. So again, we can use the multiples to help us with our valuations. All right, so this is really just kind of going over the three parts of the analysis that we're going to practice on with our extra credit assignment. This is the other two sections that you need to go through for your group projects. And this is what your next assignment is going to be due. We'll go over this on Monday, is going to be for that extra credit assignment. All right, questions by that?